So what I did today was just kind of put some basic tax changes for 2022 that I think this group will, most of you may already know it, but if not, there's a few items I thought was interesting. So if you could go to the next slide, Ken. So first one is the IRS did increase our tax brackets. It's like by about 1.3%. So you're getting about $300 to $350 if you're single, married, filing jointly, or head of household. That's kind of what they increased it by. So if married, filing jointly, you got about a $650 increase across the board for the different tax brackets. As you can see, not much of a benefit, but still a change. Going to the next slide, Ken. Here's one I think that can help a lot of you, especially if you have your own S Corp, LLC, where you have kids that do work for you. And that is actually the standard deduction for singles. So in 2021, $12,550. As long as you earned under that, you really didn't have to file taxes because you had a net zero in taxable income. So they did increase that by $400. So that's an extra $400 in 2022 that you can pay your children that work for you and lower your income tax on your end. And pretty much instead of giving an allowance after with dollars after tax, you can pay them up front with this way. So that was nice to see. Yeah, go ahead, Chris.
Quick question on exactly that. You mentioned two things in succession there. One, you don't necessarily have to file your taxes if you make less than that. And then you talked about paying your kids. Yep. So I do pay my kids, and I usually, and I've always paid them, well, no, I shouldn't say always. When they got older, I started paying them up to the standard deduction. But I always file a tax return for them. And I guess just to start the statute of limitations. Yep. Do you feel that that's the right way to go? Because I'd rather not have to pay to file taxes for them. But
so it really depends on it. Are you having any withholdings done with your kids' taxes return? Because
there is nothing. I mean, it's because they're not going to be taxed on it. So
correct. So I would say if they were having any withholdings, definitely file taxes. If they don't make it, I mean, technically they are not required to file, but depending on how much you're being charged to file them, I'd probably still file them just for documentation, because I always like having more documentation than less.
Me too. Me too.
And that way, if you ever get audited and they say, did you really pay your kids that? Even though there's checks, you can point them to the tax return. So I would still keep filing them, but that's just me being probably over the top.
I feel the same way.
So
now look, Anthony's back.
Hey guys, sorry about that. It literally, you guys know, calls coming in from important things. The last question isn't relevant to what we're going through right now, so I will ask a question that I just put in there. There, okay. Brendan's asking similar. So I've got two kids that are actually eager to do something for any of our businesses, and I'd like to exercise that opportunity, but they're 8 and 11. That work? Or is that against the law?
So I think age requirements don't really take a matter in this instance. It's more if they're actually doing work. So some people can have a 3-year-old and they use them as models and advertisement. So they'll write them checks for modeling. So as long as the kids are actually doing work, you can pay them. That's my viewpoint on it. Does anyone else have a different viewpoint, or what have they heard?
I only because I've been doing this for like over a decade. Not that you're wrong. I'm just going to add a little more flavor, I guess, to it. Is that, look, paying your kids $13,000 a year, your 3-year-old, that's just ridiculous. And saying that you actually model them and they don't have any modeling work outside you, like putting one flyer out a year. Good luck with that. I mean, yeah, you'll get the write-off and you probably won't be audited, but if you are, you're going to lose. So I'm a big believer in pay them commensurate with what their age and what they're actually doing. A 3-year-old, like the classic one is exactly what P said, the modeling thing. I avoid it like the friggin' plague. Unless you've got a kid who is already modeling, then use it. If not, it's just too much of an audit plug. Look, can they shred papers? Yes. Can they take out the trash? Yes. Can they clean the window or the mirrors and your office a bit? Sure. Not a 3, but like a 5 or 6. Sure. And pay them a few grand a year. And then every year as they get older, you can pay them a little bit more, and increase their responsibilities. And this is not just a tax avoidance thing. This is a great way to teach your kids responsibility. I tend to, when I was paying them only up to about 6 grand, or actually it was 5 back then was a limitation. I just threw it all into a Roth IRA for them because they didn't have to pay any taxes on their income, and they didn't have to pay any taxes on putting that into a Roth IRA, and my company got a write-off. So that is some of my opinion on that. I've got a few others, just in terms of what I'm seeing here in terms of Brandon, if you have to pay the FICA taxes and such. The short answer is no, up to 18, unless you're paying them out of an S corp, then you do. Yeah. So I have an S corp. I don't want to pay them out of my S corp. So I created an entity that is basically under my own social security number. So it's just a pass through called Weiler Family Management. And I pay, my S corp pays that and then pays my kids, so that I don't have to pay that FICA. Now, and that's up till 18. Now I have a 19-year-old now. I am likely not going to pay her this year. But one potential way to avoid FICA taxes, if you are going to pay a kid that's over 18, is to do like a one-time project. Like if your kid is good at programming and you give them a big project that involves some kind of programming stuff, if it's like a one-time project, it's not considered an active business, and it could potentially avoid having to pay those FICA taxes and such like that. But that's like you can't do that like every year and be the same thing, or do it multiple times a year and then declare that it's not an active business. But a one-time project here and there, you could get away with it.
So you're paying.
That would fall under the other income on the Schedule 1. So that's how you note that for the child.
Chris, are you, to dig in on that a little further, your S corp is paying the Weiler family entity, and so then are you paying FICA on that? How is that? Because it's an entity. I'm curious because that's what I have an S corp that is an e-commerce business, and the kids that's what they're going to help with. That's what I want them to help with, and
so think of it, if you were paying any other vendor out there, you wouldn't have to pay FICA for it.
Right.
They're like contractors, independent contractors under that Weiler Family Management Company. And I am paying Weiler Family Management Company as an independent contractor.
Makes good sense. I like that.
Yeah.
Thank you.
Now, if you have an LLC and it's not taxed as an S corp, you can skip, or you have a sole prop, you can skip that. But since I'm paying them out of my S corp, that's the way to do it.
Yeah, yep. That's the business that they would be working for primarily. All my other ones are S corp or LLCs though. So that makes. But I like that. I like that approach. Thank you.
Sure.
One other thing I wanted to throw in there is, I'm in this business because when I was a kid, my dad put me to work in his rentals. And so, I learned to, troubleshoot plumbing and electrical and drywall and cabinets and landscaping and repairing roofs and all of that kind of thing, because I learned it as a kid. And then, I grew up and I went off doing other stuff. And then eventually I figured out, oh, my dad is actually pretty smart in doing this. So getting your kids involved in the business, I think gives them some real skills that may be quite useful to them later on.
Yep. That's a good point.
We involve them in those things anyway. We just haven't, the connection that I'm making here from the conversation that was just brought up, that people are is compensating them in a way that is also a tax advantage way for us. So that's the light bulb moment. But yeah, I love showing them things like that.
As Chris did mention, it's got to be reasonable. So
yes, reasonable is the number one word that my CPA uses for anything that we do.
Yeah.
And necessary, actually. I think those are the
Correct.
two.
Yeah.
Now, just to put a little flavor on it too, is that like I like to put as much as I can into Roth IRAs for them. And then the rest, goes into an account in their name. And then it can be used, either you could put that into savings for them, or you can pay expenses out of that have to do with them. But just make sure you do that. I mean, it's just, we all get lazy, and then you transfer it over there, and then you transfer it back into your own joint account with your wife, and you don't keep track of it. Look, guys, it's a pain to do these things, but if you miss them and you get audited, it's just not worth it. So make sure you do it.
Mm-hmm.
So you want to unpack that further if everyone thinks that's a good idea, like how are you doing this into the kids? So you've set up a Roth IRA in the kids' names,
Mm-hmm.
and you're paying that from the Weiler Family Corporation.
Mm-hmm. Okay, so exactly. And what I do is, look, I mean, to set up a DBA is so easy.
Yeah.
You basically, you could just Google it, but basically you got to put an ad for like $10 or what that says that my name, this is a DBA for my name or whatever like that. And that will work. You can get a bank account in the name of the DBA. What I do is like, for instance, I use Charles Schwab for that. So I have a bank account in the name of the DBA. I have a bank account in the name of my daughters, or brokerage accounts to be specific, and then brokerage accounts, specifically for the Roth IRAs. I have it all under the same, bank or brokerage firm, and all set up where I can do transfers online really easily, and it just makes it, not tough to do. So yeah, I just send a check from my. Now you got to make a contract between your S corp and your DBA. Make it legit, mm-hmm. and make sure that you have the list of all the things that they're doing for your S corp, in that contract, and that could be increasing amount of responsibilities as your kids get older, and have a contract with that DBA to your kids that they sign, and have the money going from your S corp over to your DBA, and then over to your kids. And personally, the way I do it is I do at least a monthly meeting, and I do the whole Augusta rule thing where I, rent out my house to myself. During that meeting, I write up minutes. And when I do all my expenses, when I pay myself from the Augusta rule over, I also do transfers out, to the Weiler Family Management Company. And I just have this whole system where at least once a month, everything gets transferred over and in place. And then it's all backed up by minutes and everything else, and contracts. And it sounds like it's onerous, but once you get all the paperwork down, I mean, minutes are a piece of cake. You just copy the minutes from the last month and do some changes from, change the dates and, do updates to what you already talked about, and add a few more extra things in there. And it's a piece of cake to do.
Yeah.
Love it.
And then, Chris, you can also do that 6,500 for the Roth IRA or IRA on top of the 12.5, right? Is that what you've done in the past, or was that a different individual?
The 6,500 on top of the 12.5? No, it's my understanding that 12.5 has to come out of earned income only, right? Or am I mistaken? Because I'd love to see if it was higher.
I've seen some returns where they do the payment of around 12,000, and then there's also 6,500 for like 18,000 total.
Ooh,
so
I'll have to look into that. I'm not aware of that.
If it wasn't a Roth, that would make sense. But if it's going into a Roth, that would be taxable.
Okay, so not Roth, but a normal IRA, I think, is what I've seen. So you might be able to get up to 18. So
although I think you're wasting a huge opportunity by, well, I guess it's getting more money out, and it's more right out for you. And they're at, even at just 18,000, I mean, only 6,000 taxes. They're at such a low tax bracket that might be worth. Actually, you might want to do that and then convert it over to Roth.
Yeah,
and pay that minimal amount of tax on that 6,000.
Yeah.
Sure.
So I'll see if I can find something on it. I'll try to post a Discord tonight or tomorrow on that for those who are interested.
Yeah, please do. I'm highly interested in that.
So, all right. Well, what we'll do is run through the other stuff real quick, and then we'll ask questions as well as we go through those. So Ken, could you go to the next slide? So on top of the standard deduction going up, if you have an HSA account, that's getting increased $50, not a significant amount, but that's as individual, $100 for a family. So again, another way to put money away pre-tax to pay for health costs later on in life to help lower your current income. Ken, next slide. And then for those who are wanting to give gifts, that has increased to $16,000. You can give tax-free per person. It used to be $15,000. That was held flat since 2018. If your state is 12 million, you're in essence can kind of pass that tax-free on. It was about a $300,000 increase from 2021. Went from 11.7 million to 12 million in essence in a state tax exemption
Per person.
per person.
So
Yep.
very double for now.
Yep. So again, that's
a question just on that, Pete. Sorry about that. So
I'll go back, Ken.
So if you have an estate tax exemption of roughly, let's say 12 million, why, and you pass it on to your kids, it's a separate tax filing you have to do, but why is the 15 or 16,000 all that relevant from an annual perspective? I mean, if you give 100,000 this year, doesn't it just go towards the state tax exemption? Unless you think you're going to go over that 12 million.
So if you do 100,000, the difference between the 84,000 in essence would lower your tax exemption of 12 million by 84,000. And so you wouldn't have 12 million later on when that happens. So what people try to do is when they get close to that 12 million mark is they'll just start gifting that 16,000 pretty much every year to every individual that they want, or married couple 32,000 to kind of try to hover close to that 12 million.
So
If you're an
let's
individual.
say you're an average Joe and you don't plan on, having $12 million in your estate when you pass away. Is it all? I mean, that's kind of my point. Let's say you only have 10 million, and why does it matter? I'm always kind of caught up with the $15,000. Why does that matter if you say I'm never going to go over 10 million?
Peter, I'll tell you why it matters. It's a couple of reasons. One, if you're ever giving somebody a gift and it's more than $16,000 now, there's going to be taxes owed. That's just something, to know. But probably more importantly, if you're passing on 10 million bucks in today's exemption, you're okay. But if you get an extreme, that could change. I mean, this sunset, Pete could probably tell us when this sunsets, but it sunsets down, I think, to like 1 million or 5 million in like 5 years or whatever. And if Congress, doesn't change that, then one reason why you do these gifting is because you don't know what that future exemption is going to be.
When it's sunset, though, if you've already contributed $2 million, isn't that already protected under the estate tax exemption? And if you do give that $100,000,
they're separate, right? I don't think that one has to do with it takes from the other.
There is $1 million exemption one that'll eat into, but let me address two things first. As Chris said, in 2025, that $12 million mark will be down to 5.49 million. And under the current administration and Congress and Senate, they want it closer to like 1 to 2 million. So that's why you want to start bleeding the 16,000 is to get your estate as low as possible. So if when the law sunsets in 2025, 5.6 million 5.49 million per person, sorry, you want to try to just get as low as possible depending on who's running the government and what tax laws they enact. So
I thought it was grandfather. Let's say it does go to 5.6, but, and again, I'm just using rough numbers here. Let's say I've till this date contributed 10 million into, segregated family trust, and it was already funded prior to the sunset. Isn't that protected? Grandfather's in.
is
That's
it
my
revocable?
But you've already transferred it out. That's the difference.
Right.
It's like three different things we're talking about. But yes, it was a short answer.
So it is
Correct.
protected. But then
In a
why would
revocable trust, yeah.
why would the 10, let's say you contributed $100 million, why would that difference between the 15,000 be taxed? I thought it's just carried over in your taxes.
So if you give 20,000, in essence, there's going to be a $4,000 tax to someone.
It is, okay. I thought it kind of counts towards that that estate tax exemption.
But that 4,000 can lower that exemption. It is the last article I read on it.
Okay.
It lowers your lifetime exemption then. That's how I've
Right.
understood that.
I think we're agreeing. So it does lower the 12,000 or the 12 million, but then let's say it's sunset and you've already accumulated 10 million in there, and that's grandfathered in. In my head, that means you don't owe any taxes, but maybe I'm just totally wrong on that. And it's okay for you to say that.
Yeah, I don't think you could do it that approach because the annual exclusion, that extra 5,000, and in your example, would count towards the exclusion, which you're saying is correct, but I just don't think you can do 10 million gifts without having to pay tax implications. So.
Yeah, if I could jump in here too. I mean, one of the things that I've been thinking about as my kids get older or I get older is, and maybe you could step in here too, is that, because we're all involved in real estate, I think there's some interesting plays that you can do there. I kind of fear the idea of going to irrevocable trust only because it's a lot harder to get out of, and there's tax implications and other issues. But I've been considering something like a family limited partnership where your kids get increased amount of interest in it over time and therefore can potentially bypass some kind of estate taxes. And it could even be where their interest increases, but maybe their control doesn't. And there's a lot of different plays that I think we have as real estate investors that maybe your average Joe with a stock account just don't have.
That's a good point.
Yeah.
Okay. Thank you.
Peter, your mic is so much better now. It's like HD, man.
Yeah, we can hear you.
Computers, but
I like that option, Chris. I mean, I think if you do consider your real estate business as a real business, and we're both in California, but for me, the way it is, both my wife and I are 50-50 owners, and we could just start introducing our kids as, okay, they're 1%, they're 2%, they're 3% over time. Their percent ownership of the business is increasing, and you could probably limit the tax implications of them moving from a minority position to a majority position when you pass.
I think it can also help you out in the present as well. I mean, assuming a couple of things. I mean, one, if they're interested in getting involved, that's a great way to get them, into the business and get benefit from it. And also, if they're in a lower tax bracket per se, shifting some of that income from your current, entity into them might be beneficial as well.
Yep.
I have an idea, might work for you, Chris, and Pete can correct me if I'm wrong. So have your kid buy a land that's super cheap and they rent it to you, and you build a mansion on it. So let's say they bought a land for 500,000 and you build a mansion with 2 million improvement. Now their house is worth 2.5 because you are a tenant and all the improvement you are doing is tax-free for them.
Wait a minute. Did you say buy cheap land and then you said $500,000?
Yeah. In Chris,
California, yeah, that's cheap.
California.
California.
That's
New York City.
so the key is for them, they have a low base and then they rent it to you. You spend all the money to build the house. Any improvements done by the tenant is tax-free for the landlord.
Interesting.
So you
I love my kids. I'm just not building them a $2.5 million house.
Yeah, but you got to realize 20 years from now, that's going to be like a $500,000 house. My God.
Yeah,
That
so
sounds
that's
interesting.
the
But
way.
if you're not the owner, I mean, this would mean you'd have to have cash. I mean, it'd be harder to get a loan if you're not the owner.
Yeah, and most tenant improvements are kind of the landlord giving it to the tenant to build their commercial space. So
I love the creativity, though.
I think in theory it sounds good, but there might be some speed bumps you'd have to overcome. So, but it's a good idea.
Okay.
Yeah. Maybe it's just the numbers are making me a little nervous since they're in the millions, but could work. Because usually it's the landlord giving the tenant money to update the property. But we'll
Or
see.
your kids can buy a really beat down multifamily and then rent it to you, and you as the sublease landlord make all the improvement value add, and then the value of that building is going to go up, and it's not done by your kids, it's done by you, so that all that improvement is tax-free for your kids.
Yeah, that'd be more of a leasehold improvement on that aspect. But yeah, I know I get your example. So
Okay.
yeah. All right. We're almost at time. So Ken, we'll just post this in Discord. The other one was just kind of more contribution levels to the solo 401k. You can contribute an extra $1,000 for the employee section. And then due to new laws and regulation, you'll be getting a 1099K from like PayPal or Venmo if you use those and get over $600. So that was kind of the rest of the slide. So we'll have this slide deck posted in Discord.